If you've been following the markets and the news in the past week, tariffs are all over the headlines. April 2nd was Liberation Day, where President Trump announced some of the new tariffs imposed on imported goods. This has caused a lot of fear, some confusion, and even a sharp drop in the market recently. So today we're going to break down what's really going on. While most of the news is very negative on tariffs, we'd like to give you a balanced, basic view about what tariffs are, why Trump is pushing for them, how they can be used to reduce the trade deficit, and why famous investors like Ray Dalio believe that they're not just inevitable, but strategic. So my name's Aiden Borstein. I'm here with Steve Borstein. We're both financial planners at RockCrest Financial in Summers Point, New Jersey.
So let's get started with the basics. So what are tariffs exactly? Well, tariffs are essentially taxes on imports. When a foreign company sends goods to the US, the government can charge a tariff, say 10% or 25%, on top of that product. The goal? To make imported goods more expensive so that American consumers and businesses are more likely to buy from US manufacturers instead. So tariffs have always existed, and other countries have tariffs on the US.
So let's talk about the pros and the cons. The upside of tariffs is that they can protect domestic industries from cheaper foreign competitors. They can also encourage companies to produce goods here in the US. They could preserve or even create American jobs. They could generate tax revenue that goes directly to the government. And they give the US leverage in global trade negotiations.
But the downsides are real too. So tariffs can raise prices for consumers. They can increase costs for the US businesses that rely on imported goods or materials. They may lead to retaliation from other countries, which can hurt US exporters. And they can cause short-term volatility in the stock market.
And that brings us to what's happening right now. So recently, financial markets experienced significant declines following President Trump's announcement of the comprehensive tariff plan.
So the immediate market reaction has been pretty negative. Investors are concerned that these tariffs could escalate global trade tensions, leading to retaliatory measures from the affected countries, increased consumer prices, and potential disruptions to international supply chains. Economists warn that such developments might contribute to inflationary pressures and raise the risk of recession.
But here's where we need to take a step back. Is all of this fear justified, or is it an overreaction? Yes, the markets hate uncertainty, and tariffs introduce a lot of that. But fear-based sell-offs are common when news breaks that feels dramatic but doesn't play out immediately or on the same scale as investors imagine.
So let's also talk about Ray Dalio, who's the founder of Bridgewater Associates and someone who's spent decades studying global economic cycles. So Dalio recently commented on the tariff headlines in a post on X. And here's what he said. The tariff war is a natural development and part of the greater US-China competition. It's been coming for a long time and will likely intensify. What's happening is much more than just a trade war. It's a war of ideologies, technology, geopolitics, and ultimately military power.
This is an important perspective. Dalio isn't framing this as a temporary economic blip. He's saying it's part of a much broader and long-term shift in global dynamics. To him, tariffs aren't just about economics. They're a tool in a bigger geopolitical strategy. It's not just the US and China competing over goods and services anymore. It's a clash over technological dominance, global influence, long-term national strength.
And Dalio believes these kinds of tensions were inevitable. The implication is whether that is Trump, Biden, or anyone else, the US was bound to start pulling back from economic dependency on rivals like China. So again, when you see markets reacting, remember, this just isn't about short-term headlines. It's about how nations position themselves for the next decade and beyond. Investors may panic today, but policymakers are playing a much longer game.
Think about it. Over the last few years, we've seen a global pandemic that's disrupted supply chains, rising tensions with China, a war in Ukraine that's impacted food and energy markets, and now increasing competition in tech, AI, and energy security. In this environment, relying heavily on imports, especially from geopolitical rivals, isn't just an economic vulnerability, it's potentially a national security risk.
And that leads to another big point, the US trade deficit. So for decades, the US has had a massive trade deficit, importing more than it exports. In 2023, the trade deficit was over $770 billion. And that means that hundreds of billions of dollars are leaving the country each year. So Trump's plan is to reduce that deficit by taxing imports, making US-made goods more attractive and shifting more production back home. In theory, this reduces the money flowing overseas and helps stimulate domestic industry.
But there's also a revenue side to tariffs. A 10% universal tariff on all imports could generate tens of billions of dollars in government revenue annually. That could be used to help offset the federal budget deficit, which is ballooning into the trillions. So in Trump's view, the tariffs serve multiple purposes. Reduce reliance on foreign countries, bring jobs and manufacturing back to the US, use economic leverage to negotiate trade deals, and generate revenue that can reduce the deficit or fund domestic programs.
Again, there's a trade-off. Consumers may face higher prices, businesses may have to restructure their supply chains, and markets might stay volatile for a while. But the argument is that these are short-term costs for long-term gains. And if tariffs are used strategically, not as a blunt force tool, they can be adjusted, scaled, and even targeted to specific industries or nations.
So what should you take away from all this? Yes, the market dropped. Yes, there's fear around tariffs, but take a breath. This kind of strategy isn't new, and if executed carefully, it could be part of a bigger plan to secure America's economy for the future. If not, tariffs can be reversed. The government also has other ways to stimulate our economy, including decreasing interest rates and other policy decisions. Compared to a pandemic like COVID, which we couldn't control, political policies and positioning like tariffs can be modified and changed. And that's good news. People like Ray Dalio aren't ringing alarm bells. They're saying this is just the beginning of a new economic reality.
And the more prepared we are for it, the better. And just a side note, maybe we'll come out with a video on this next topic. But when the markets drop, not everything drops. There's investments in sectors of the economy that can stand to benefit from tariffs. And this video isn't a political statement. We're just trying to give a balance as to the good and the bad of tariffs so you can help make decisions, better decisions on your financial planning and your investments.
Thanks for watching. If you found this breakdown helpful, hit the like button and subscribe for more financial insights. Also, drop a comment with your take on tariffs. See you in the next one.